You're watching Silver News Daily. Subscribe for more.
Did you know that silver could skyrocket to all-time highs any moment now? It's not just a hunch. There's a powerful combination of factors aligning right now, and top experts like Schectman are warning that this could be our last chance to stock up before the big surge. From the shifting global economy to unprecedented central bank activity, silver's potential for explosive growth has never looked stronger. In today's video, we'll break down why silver's poised for massive gains and what that means for anyone looking to protect and grow their wealth. Stick around. You won't want to miss this.
And I think the key is also without counterparty risk. I don't think the bonds can longer fully provide either. You see the Fed lower rates, as we've talked about. There's all this talk of signaling victory over inflation, but it's not. They were 60+% away from their target at 2%. What it is raising the white flag. What it is massaging and manipulating the numbers that comprise the CPI out of the Bureau of Labor Statistics. And whether it be about unemployment or about inflation, the numbers that come out of there are suspect, to say the least. And what we are seeing, really, as far as I'm concerned, is the market's way of saying, at this point, buying any duration treasury. This is me talking. Let me just say this, that anyone who would buy any duration treasury, 10-year or longer, to me is crazy. I think they're uninvestable. The Fed will lie about inflation. Inflation will only get higher from here, especially by lowering the front end. And the market understands this. Gold understands this. This is why gold is roaring. This is why the bond market is selling off and rates are going higher. And of course, you can talk about the weaponization of the Treasury market, which only adds fuel to that fire. But this is something that I would expect to see continue. You cannot expect to lower rates, go back to an inflationary policy, especially with asset prices at all-time highs, and not expect there to be consequences on the back end of the curve, where holding at these rates for any duration when inflation will erode and eat away at the purchasing power is insanity. And so I think that's the market saying just that.
Now, before we dive into the deeper analysis, let's take a look at the current landscape in the silver market. Silver has been trading in a tight range, hovering around the $1.33 mark. But here's what's really interesting. Recent price movements are showing signs of a possible breakout. With the US dollar slightly softening and precious metals holding firm, many believe silver could be primed for a massive upward swing. If silver breaks past its current resistance points, it may set the stage for a new all-time high. So what exactly is causing this mounting tension in the market? Let's dig into why experts are eyeing silver's next big move and what this could mean for those watching closely. And don't forget, if you're finding these insights valuable, be sure to hit that subscribe button to stay ahead of the latest trends in the precious metals market.
And this is when you get into systemic risk, counterparty risk, reinsurance risk. This is why they had to bail out AIG back then, because they are the ones that would sell all the credit default swaps, and the cascading of failures would very quickly blow up the entire system. And it's very dangerous. These derivatives where the value is based upon a counterparty's ability to perform. And in this environment, who knows what these counterparties' ability to perform truly is. So yeah, I see tremendous risk as well. And you can see that by how high the credit default swap premiums are going up. Market sees it too. This is something that ultimately is inevitable to some degree. I mean, to some degree, you have to have a cleansing of the system and the continuing of papering over these problems that, in 2008, when all of this happened, the Fed's balance sheet was $800 billion. It reached $9 trillion a year ago. And that was all by purchasing interest rate sensitive investments like treasuries and mortgage-backed securities, both new ones and toxic ones, to drive down interest rates to smooth over these problems that really didn't go away. They just were hidden under the surface and growing and lamenting, and probably will only be worse when they finally exert themselves. But there is a a structural problem within the banking system, and higher interest rates on the back end of the bond market will expose much of this very quickly, as these banks start to run into defaults from the loans, these bad loans that they have out there, which, with their walking dead companies, it's a real deal. And I think what happened with the bank in Lindsay, Oklahoma last week must be realized. And the interesting thing about all of it is that there's no word of it. I did an interview with Jay Martin yesterday, and he had no idea about it. And Jay's a smart dude. Jay is well connected, tuned in, works his butt off, studies hard like you and I do, Dunnigan, and he didn't know about it. Now he's in Canada. The point of it is that if a guy that's tuned in and plugged in and reading and researching and preparing for people he's interviewing, you would think that he would know. No, there is a specific plan or whatever you want to call it to not let this information out, but just enough to say we told you so. I would think that this is just the very beginning. You could say it's a slow fuse that was lit in Lindsay, Oklahoma, that we will see much more of as days and weeks go by. And it's very ominous and eerie that this BTFP ends on the 6th. You want to talk about rug pull? They could pull the rug right out from underneath it. And you look at the betting odds. The betting odds show that Trump is about a 2-to-1 favorite. And I think the betting odds are better than the polls. Vegas knows more than the polls do. And, you want to talk about letting all of this blow up on his watch. You want to get conspiratorial. Sure, I could see all of that stuff happening. I think it's going to only get crazier after the election, and the banks are a perfect tipping point to ignite that fuse.
Now, before we dive into the deeper analysis, let's take a look at the current landscape in the silver market. Silver has been trading in a tight range, hovering around the $1.33 mark. But here's what's really interesting. Recent price movements are showing signs of a possible breakout, with the US dollar slightly softening and precious metals holding firm. Many believe silver could be primed for a massive upward swing. If silver breaks past its current resistance points, it may set the stage for a new all-time high. So what exactly is causing this mounting tension in the market? Let's dig into why experts are eyeing silver's next big move and what this could mean for those watching closely. And don't forget, if you're finding these insights valuable, be sure to hit the subscribe button to stay ahead of the latest trends in the precious metals market.
And this is a very, very bad thing. That's when the Federal Reserve came in and injected liquidity to keep the banks from collapsing, these emergency loans like the BTFP, which we've talked about. And ironically, the BTFP expires November 6th, the day after the election. And I think when that happens, adding more fuel to a fire, we can expect to see a tightening of liquidity, of course, for the banks that have been depending on it. And particularly, this really affects the small banks, the regional banks. The regional banks are the ones that hold 70% of the commercial real estate loans. They're the ones that hold 70% of the small business loans. They're the ones that are getting clobbered. And so either the question then becomes, if the BTFP ends, is the Fed going to step in again when we see a strain in the banking system? And I think that's really the $6 million question. You could see a massive exodus, if you will, of deposits moving to the perceived safety of the larger banks. And I think you could see what happened in Lindsay, Oklahoma a week ago happen in spades. And I think that that's something people should really be watching, as the liquidity really is being sucked out of the system. And with the ending of this loan program on the 6th, it's only going to add fuel to that fire. So we have not experienced the end of the banking problems. And this liquidity problem is really this credit issue. It's real, and it's not going away, and especially to a over-leveraged, undercapitalized banking system that is about to really experience problems when all of these loans and leases, and in particular commercial real estate loans, start to and continue to reset over the next several months. Without that injection of cash that the Fed has been doing, I guess we'll have to go back to quantitative easing again, and that just exacerbates the sell-off of the back end of the bond market. You're trapped. In other words, either you let the economy sink into a depression, or you continue to do what everyone has done prior, and that is to inflate the heck out of the currency, which the bond market will sniff out and which gold already is sniffing out. And I think that's why you're seeing these things happen concurrently.
Now, let's talk about one of the biggest forces that could propel silver to new heights, the US dollar. Silver and the dollar have an inverse relationship, meaning that when the dollar weakens, silver often gains strength. Lately, the dollar has been showing signs of softening after one of its longest rally streaks in recent memory. But why is this important for silver investors? Here's the deal. A weaker dollar generally makes commodities like silver more affordable for investors holding other currencies, which boosts global demand. Recently, the dollar has been struggling to break through a critical long-term resistance level, and analysts are starting to speculate that it could be on the verge of a major pullback. If this happens, it could create the perfect storm for silver prices to surge. Think of the dollar as a gatekeeper in the world of precious metals. When it's strong, it holds silver back. But if it starts to fall, it's like opening the floodgates. Why? Because a declining dollar increases investor appetite for assets perceived as stores of value, such as silver, gold, and even other commodities. And it's not just individual investors. It's central banks, institutions, and funds, all looking for ways to hedge against a potential dollar decline. Let's dig a little deeper. Many experts, including Schectman, are watching the Federal Reserve closely. With ongoing inflation pressures and uncertainty around interest rate cuts, there's a very real chance that the dollar's strength may not last. If the Fed even hints at easing monetary policy or cutting rates, we could see a rapid shift in the dollar's value. This would likely drive a surge in demand for silver as investors look for safe havens in an uncertain economic landscape. And here's another layer to consider. Silver, unlike gold, has a unique dual role as both a precious metal and an industrial commodity. This means it could see increased demand not only from those looking to protect their wealth, but also from industries that rely on silver, like tech and renewable energy. Imagine the ripple effect of a declining dollar pushing up silver prices, while industrial demand continues to grow. That's a recipe for explosive gains. So we're at a pivotal moment. If the dollar dips further, or if we see any indication of easing from the Fed, it could set off a chain reaction that makes silver one of the most attractive assets on the market. And this brings up an interesting question for you. Are you prepared to ride this potential wave? Next, we'll look at how central banks around the world are playing into this equation by stockpiling precious metals. And don't forget, if you're finding these insights valuable, make sure to subscribe so you don't miss out on more breakdowns like this that could help you make smarter investment decisions in these turbulent times.
As it gets tougher, as liquidity dries up, banks, as you mentioned, they become reluctant, if you will, very reluctant to lend to one another due to that fear of insolvency. These banks are already over leveraged and undercapitalized, and they rely heavily on short-term funding. And when this liquidity tightens up and banks struggle to get the cash that they need, it leads to a freezing in the interbank lending. That's what we saw in 2019, to your point. And without these funds, banks are, they'll be forced to cut back on loans to businesses and individuals. And this, in a model, if you will, in a perfect world, this reduces overall economic activity. And then you factor into it. Of course, you also have what's called crowding out, which is the higher interest rates drives up or reduces the availability of credit to the private sector. And what you end up having is a contraction in economic growth because it's just too much money or it's too expensive to access money, and which leads to lower tax revenues. It's a doom loop. But in particular, this is something that when you add into it already the commercial real estate problems, the loans that are resetting, the majority of all of the loans, the mortgages, the credit cards, the leases, all of this is done off the 10-year. And so you push down the front end, which really doesn't do a whole lot other than make the short-term treasuries that we've shifted our lending or our borrowing to the short term, makes those a little bit easier. But in terms of what affects the consumer, it's pretty much the 10-year, which is going the other direction. And so you're going to have, as these commercial loans and leases reset in a slowing economy with higher interest rates, a strain on credit, it can lead to a cascade very, very quickly. And then you end up with what happened during the pandemic, where these banks, or the banking crisis rather, where the banks they needed cash, and so they had to sell assets quickly. Those were the treasuries that led to, a collapse in the banks, that all of these assets were underwater. They had to be sold at distressed prices. And
All right, let's dig into a crucial development that could massively influence silver's future: the role of central banks. Around the world, central banks have been stockpiling precious metals at an unprecedented rate, especially gold and increasingly silver. So, what's driving these massive purchases? And why does it matter for individual investors like you? Central banks, especially in countries like China and Russia, are accumulating precious metals to reduce their dependence on the US dollar. In fact, China alone has been on a gold buying spree, adding tons of the metal to its reserves in an effort to diversify away from dollar-denominated assets. This trend isn't just about portfolio diversification. It's a strategic move to prepare for economic shifts and potential geopolitical uncertainties. And silver, often dubbed poor man's gold, could benefit from these shifting dynamics as well. Think about it. When the most powerful financial institutions in the world start piling into precious metals, it sends a message. They're hedging against currency fluctuations, inflation, and other systemic risks. This central bank buying trend adds a massive layer of support to the precious metals market, setting a strong foundation under prices. And since silver often moves in correlation with gold, an increase in gold reserves could signal an upswing for silver as well. Why should you care about what central banks are doing? Because their actions have a domino effect. When central banks buy up vast quantities of metals, they reduce the available supply on the market. This tightens the supply chain, creating scarcity that drives prices higher, and it's not just about the current buying trend. Central banks are holding onto these assets for the long haul, effectively removing a chunk of the supply from circulation. This makes it increasingly difficult for the market to meet growing demand without pushing prices up. And it doesn't end with central banks. As they set this trend, large financial institutions, funds, and even individual investors start to follow suit, creating a cascading effect in demand. When you combine central bank purchasing with silver's industrial applications, which we'll explore soon, you start to see just how powerful this setup is. Now, here's a question to think about. If central banks are moving so heavily into precious metals, what do they know that the average investor might not? Could it be a sign of bigger shifts in the global economy, or maybe an underlying caution about the future of fiat currencies? Stick around as we dive deeper into silver's unique role as an industrial metal, a factor that could give it an edge over gold in the long term. And if you're enjoying these insights, make sure to hit that subscribe button so you're always ahead of the curve on the latest market trends and opportunities.
a little bit better. I think they all will face similar issues, but they're probably better, especially those that that are not making outlandish investments or purchasing toxic assets, or are a little bit more constrained in the way that they make their loans. But I think in general they're probably better than the regional banks. In general, yes, but I do think that they're not immune to the problems, especially if the whole system goes down, or if we start to see a run on the banks. You'll see people pull their money out of all of the banks, and it gets to that point where the liquidity dries up so fast, that the money comes out so fast, that these banks are forced to sell their assets. And I would assume that um, these institutions, they don't have 100% dollar for dollar deposits. They're making loans, and they're also probably buying things like treasuries, just maybe a little bit more prudent than the big savings and loans or these regional banks. So, but in general, yes, I think it's probably preferred.
Now, let's turn our focus to one of the most exciting aspects of silver, its surging investment demand. In recent years, silver has captured the attention of not only traditional investors, but also a growing number of newcomers who are flocking to precious metals as a safeguard against market volatility and inflation. But what's fueling this renewed interest in silver, and why are so many investors turning to it now? First, let's look at what's happening globally. Inflation concerns and economic uncertainty are pushing people to seek refuge in assets that can retain value over time. Silver, much like gold, has historically served as a hedge against inflation and currency devaluation. With economic pressures mounting, silver's affordability makes it particularly attractive compared to gold. It's like getting similar protection for a fraction of the price, a compelling draw for those who want to protect their wealth without a massive upfront investment. And it's not just individuals. Institutions are diving in too. Over the past few years, silver-backed exchange-traded funds, ETFs, have seen significant inflows. These ETFs are designed to track the price of silver and make it easy for both retail and institutional investors to gain exposure to the metal. When an ETF purchases silver, it needs to buy physical silver to back its shares, which adds substantial demand pressure on the market. With more money flowing into silver ETF than ever before, the demand for physical silver has surged, making the metal increasingly scarce and pushing its price potential higher. But here's the real kicker. Unlike other assets, silver is both an investment and an industrial metal, which creates a unique double demand. Investors are buying up silver to hedge against economic instability, while industries need silver for everything from solar panels to electronics. This dual demand strengthens silver's price floor, making it less likely to experience sharp declines and more likely to benefit from sustained demand over the long haul. Imagine silver as a balloon filling with both investor and industrial demand. As this demand continues to rise, the pressure builds, and eventually, the price of silver could lift off in a way that's hard to ignore. And with central banks and institutions showing increased interest in precious metals, we could be looking at a perfect storm where investor and industrial demands converge. So here's something to consider. Is silver becoming one of the safest places to store value in these uncertain times? And if more people start thinking the same way, what could that mean for silver's price over the next few years? Stay tuned, because next we'll dive into silver's role in crucial industrial applications that extend far beyond traditional investing. And if these insights are resonating with you, don't forget to subscribe. You won't want to miss the breakdown of how silver's industrial side could supercharge its value even further.
You look at the law on it, and it says, and Florida, I believe, has it in front of their legislature, but it says you can't, in the states that have already passed legal tender laws, it says you can't make a person or a shop take your gold or silver, but if they agree to it, it's perfectly legal. So yeah, if he lives anywhere near southern Florida, Boca Raton, come on, come do my plumbing. I'll pay you in gold and silver. I think it's great. And as crazy as it sounds, you got 11 states where you could do that, and another up to 21 where it is moving in that direction. So that's sound money for you. And yeah, I agree. That's how I save my money. That's how I always have. And that's why, I say it's wealth and not an investment. Sure, it performs like one maybe and goes up, goes down, but to me, it's wealth and it's money. And I don't think there's anything wrong with people holding it that way and looking at it as their wealth and as their money. Now, it's not something you want to hold for daily liquidity, but it certainly is better than leaving your money in the bank in a system that, as we're talking about, is, teetering on the brink of solvency in some cases and worse in others.
Now, let's explore something truly unique about silver that sets it apart from gold and makes it a powerhouse in today's economy: its critical role in industrial applications. Silver isn't just a safe haven asset, it's an indispensable component in a wide range of modern technologies and industries. From solar panels to medical devices, silver's industrial demand is growing at an astonishing rate, creating an entirely separate support system for its price. Let's start with renewable energy. As the world races toward cleaner energy solutions, silver is playing a key role, especially in solar technology. Solar panels rely on silver for their photovoltaic cells, which convert sunlight into electricity. And with countries around the globe investing heavily in solar infrastructure, demand for silver in this sector alone is set to skyrocket. Some estimates suggest that solar could consume up to 10% of global silver production within the next few years, which could drive supply shortages and, consequently, price increases. But that's just one part of the story. Silver is also essential in electronics. Think about all the devices we use daily: smartphones, laptops, electric vehicles. All of them require silver because of its unmatched conductivity. In fact, it's the best conductor of electricity among all metals. As technology advances and we see more electric vehicles on the road, the demand for silver in the electronics industry will only grow. Every new device, every new electric vehicle, and every piece of emerging tech strengthens the case for silver. Then there's healthcare. Did you know silver has powerful antibacterial properties? This makes it incredibly valuable in the medical field for everything from wound dressings to infection-resistant coatings in hospitals. As the healthcare industry continues to evolve and expand, silver's role as a medical resource could contribute even further to demand. What does this mean for investors? Silver's industrial uses create a solid price floor, making it less volatile and more resilient in turbulent markets. Unlike gold, which relies heavily on investor sentiment, silver has this built-in demand from industries that will need it regardless of economic conditions. This unique position as both an industrial and precious metal creates a dual demand that's rare to find in other assets. So here's something to think about. If silver's industrial demand keeps rising alongside its investment appeal, how long before supply struggles to keep up? Could we see silver prices reach levels we haven't seen in decades? In the next segment, we'll dive deeper into the supply side of silver and why mining challenges could further tighten this market. And remember, if you're finding these insights valuable, hit that subscribe button to stay on top of every angle of this incredible silver story.
It's that razor's edge of a situation where if the Fed doesn't come in like they have before, everyone says, well, if you just would have left your money in the stock market after '08, and you would have been made whole. Yeah, well, the Fed added $9 trillion into the kitty to support the bond market, to depress interest rates, to support the stock market, the real estate market. It's all artificial. It was all propped up by a Fed who came to the rescue. What would the world look like had they not done that? And I think that's what you need to ask yourself. And the question is, will they come to the rescue again this time? And if they do, what does the rest of the world think about holding our treasuries of any duration and our currency that is being inflated away? That's the question that has to be asked. So, you get to a point where you're so far in debt and you need you need, like, let me phrase it this way. We had the second biggest trade deficit in history last month, like 108 billion or something. Well, if that doesn't tell you how important it is for this country to be the world reserve currency, and how reliant we are on the rest of the world for imports, because we are reliant upon these people taking our dollar for their goods, and we are very reliant upon buying their goods because we've offshored so much of our production and manufacturing, and it's not sustainable. You end up compromising the world's desire to hold your currency and to hold your treasuries. That's when things start to really snowball. Now, we're not there yet, obviously, but these are the kind of actions that lead to an acceleration, lead to that moment where the world says, yeah, I don't want any more dollars, or I don't want your treasuries. And this is the rise of the BRICS and trading in local currencies, and why gold is doing what it's doing. So it's all one big dirty mess, but it's all connected together.
Now, let's dive into a critical aspect of the silver story that doesn't get as much attention: supply constraints. While demand for silver is surging from both investors and industries, the supply side is struggling to keep up. Unlike other commodities where new deposits can often be found and developed, silver's supply chain faces unique challenges that could drive prices even higher. First, consider the mining situation. Silver is often mined as a byproduct of other metals like copper, lead, and zinc. This means that silver production depends largely on the demand and production of these other metals. If the demand for copper or zinc declines, silver mining also takes a hit, reducing the available supply. And with the global push toward green technologies, which favor metals like lithium over traditional base metals, there's less incentive for mining companies to ramp up silver production independently. Additionally, new silver discoveries are becoming rarer. Most of the accessible, high-grade silver reserves have already been mined, leaving only lower-grade deposits that are costlier and more difficult to extract. This creates a situation where silver mining becomes more expensive over time, even as demand increases. So we're looking at a classic case of limited supply meeting increasing demand, a recipe for rising prices. But it's not just the physical constraints. There are also geopolitical factors at play. Many silver mines are located in regions prone to political instability. For example, major producers like Mexico and Peru have faced regulatory changes and social unrest that can disrupt mining operations and delay production. These interruptions, whether from policy shifts or labor disputes, can create unexpected supply shortages, adding even more pressure to silver's price. And here's where it gets interesting. As mining struggles to keep up, silver's supply tightens in ways that directly impact prices on the market. Imagine silver as a reservoir slowly depleting while demand pours in from all directions, investment to technology and industry. Each factor pulling from that same reservoir compounds the scarcity, creating a feedback loop that intensifies upward price pressure. So what does this mean for the average investor? If silver continues to face these supply constraints, we could see a significant spike in prices as the available supply dwindles. It's a situation that's starting to look increasingly unsustainable, especially when you consider the rising demand from tech industries and global investments. With silver's supply under pressure, one might ask, how high could prices climb if these constraints continue? Could silver truly become a rare asset in the coming years? In our next segment, we'll examine how ETF and mining stocks are reacting to these dynamics and why they could serve as early indicators of an incoming silver rally. And as always, if you're finding these insights helpful, don't forget to subscribe so you don't miss out on the latest updates and opportunities in the precious metals market.
Anyways, yeah, I would just simply say the banks are not in good shape. If you have money in any bank account above the FDIC limit, I think it's insanity. We were told this by Powell. There would be consolidations. This is what they want. They don't want 5,000 banks. They want a much smaller network of banks as we transition into central bank digital currencies, making it much easier to roll out modern monetary theory if we really go down that path. But this is just beginning, Dunnigan. There's no question to me that this is just beginning, because the commercial real estate problem is not going away. People are not going back to these office buildings, and it's not just the office buildings; it's all of the establishments that have sprung up around it. And as people leave, they're these office buildings, and there's this vacuum of there's no one there, so no one is at the restaurants and the bars and the shops and the salons, and so they start to leave. And then the people who are living in that area say, the quality of life is going down, and the lack of tax revenue starts to increase because they're not getting the tax revenue they once did. So then services start to decline, garbage collection, fire, police, and well, if the quality of life is getting this bad, then I'm out too. And it's a vicious cycle that will end up very dangerously affecting the regional bank balance sheet, which I'm surprised we haven't seen more of collapse, but it's these programs that have come in and allowed a lifeline, if you will, that seem to be coming to an end. So I guess we'll see real quick what that looks like. But for people who think along those lines of conspiracy and reality and the fine line between it, maybe they've come. Let's just pretend that they've come to the belief that he will win. Maybe this is their plan to blow up the system under his watch, and with the way the media is, they'll blame him for it, and regardless of the setup that he inherited. But I think that way, and unfortunately, that's the environment we live in. But
now let's turn our attention to a fascinating element of the silver market: the role of silver-related ETF and mining stocks. These investment vehicles don't just reflect silver's current value. They can actually act as early indicators of where silver prices might be headed. But how does this work? And why should we keep an eye on these trends? Let's start with silver ETF. When investors buy shares of a silver ETF, the fund must acquire physical silver to back those shares. This means that as more people buy into these funds, the demand for physical silver rises, adding immediate pressure on the market. Recently, we've seen substantial inflows into silver ETF, signaling that investors are increasingly bullish on silver's future. And this isn't just casual interest, it's large-scale institutional demand. When big money starts flowing into silver ETF, it often points to a growing sentiment that silver prices are about to rise. Now, let's talk about silver mining stocks. Mining companies, especially those focused primarily on silver extraction, are heavily influenced by silver's price. When the market anticipates an increase in silver prices, investors flock to these stocks, driving their value up even before silver prices actually surge. It's like seeing a ripple effect. A spike in mining stock prices can often foreshadow a significant move in the silver market itself. Some experts view these stocks as a leverage play on silver because they tend to rise more sharply when silver prices increase due to their sensitivity to silver's price movements. One of the most closely watched ETF in this space is the Global X Silver Miners ETF, ticker symbol sister-in-law. This fund tracks a range of silver mining companies, making it a convenient way for investors to gain exposure to the entire silver mining sector. And lately, sister-in-law has shown signs of a bullish pattern similar to the one we've seen in silver itself. The ETF has been forming a bull flag pattern which, as we discussed earlier, often indicates the potential for an upward breakout. If sister-in-law continues to rise, it could be a strong indication that silver prices are about to follow suit. Let's take it a step further. Smaller, more specialized funds like the Amplified Junior Silver Miners ETFs, SILJ, are showing similar trends. SILJ focuses on junior mining companies, which are more volatile but offer higher growth potential. The fact that these funds are gaining traction suggests that investors are not just looking at silver's current price. They're positioning themselves for future gains, betting on a substantial rally in silver prices that could benefit both established and emerging mining firms. This brings up an important consideration. If institutional money is flowing into these silver-related funds and stocks, what do they see coming? Are they preparing for a silver surge that individual investors might not yet be aware of? Next up, we'll bring it all together by discussing why silver could be primed for an unprecedented bull run and how these factors create a rare opportunity in today's markets. And don't forget, if you're finding these insights valuable, hit that subscribe button. There's much more to come as we track this potential silver rally and market forces driving it.
And you mentioned Deutsche Bank. I think you meant Credit Suisse, which was
Credit Suisse, yes,
which was purchased by UBS, which has killed their balance sheet. But it goes to show, I mean, you could argue that the Swiss government and the regulators twisted their arm because of its systemic nature, because they are all tied together in so many ways. The Basel III regulations said that the banks had to maintain a 4.5% reserve ratio. it's been zero for quite some time. So when you think about it, you aren't depositing money in this bank. You're giving them an unsecured loan that they're buying assets with. It's gone. They only have to keep 4.5 cents on the dollar in the bank, and so they're making loans. And after the crisis that we saw with the treasuries, and now we see an environment where, okay, maybe they're buying 10-year treasuries again, thinking, okay, we everything's okay. Rates are higher and it's maybe safe to buy it. And then what do they try to do? They try to lower the front end of the curve, and the back end goes up, putting the bank's balance sheet in worse position again. These are problems that will not go away. These are problems that are, I think, systemic to the system. They won't go away, and part of me feels as though that's the intention here. I mean, you ask yourself, why would the Federal Reserve, in essence, goad all of the banks into loading up on treasuries and fueling the narrative of low interest rates forever, only to then raise them by 500 basis points, the fastest raise ever in the period of a year, creating these problems? It's absolutely insanity. But I do think that the FDIC or the troubled bank list, so there's over 60 plus banks. There's probably a whole lot more than that are in real trouble. And I don't think the First National Bank of Lindsay was on that list. So,
All right, we've covered a lot of ground, but here's where it all comes together. With the convergence of factors we've explored, silver's bullish chart patterns, a weakening U.S. dollar, massive central bank buying, surging investment and industrial demand, supply constraints, and the early signals from ETF and mining stocks, it's hard to ignore the setup for an unprecedented bull run in silver. So what could all of this mean for silver prices in the near future? Imagine this. Each of these elements is like a piece in a larger puzzle, and when they all align, they create the perfect conditions for a dramatic price surge. Silver isn't just another commodity. It's a vital metal with a unique blend of uses that span from safeguarding wealth to powering the technology of the future. With demand soaring and supply tightening, we're seeing a scenario where the pressure on silver's price could build up to levels not seen in years, or even decades. This could mean we're on the cusp of a silver rally that pushes prices well beyond the $1.40 mark, potentially even toward historic highs. Remember, some analysts are eyeing $1.50 as a target, and if the right economic or geopolitical catalyst hits, that could be just the beginning. For those invested in silver, this isn't just about profiting from a single price jump. It's about tapping into a rare opportunity in today's markets to secure and grow wealth amidst global economic uncertainty. But here's the big question. Aren't you prepared? With everything we've uncovered, it's clear that silver's current position is unlike anything we've seen in recent years. The signs are all pointing to a market poised for explosive growth, but only those who are ready will stand to benefit from the coming wave. So, as you think about what this silver setup could mean for you, don't forget to subscribe to stay updated on every twist and turn in this unfolding story. As always, remember, while silver has immense potential, this video is for informational purposes only and not financial advice. Make sure to do your own research and consider your own financial goals before making any investment decisions. We'll see you in the next video as we continue tracking this incredible journey in the silver market.
Meets the printing press, and deal with the pain for a few years, or you continue to paper it over until the whole thing blows up. And that's why, what's his name? The father of Austrian economics, Ludwig von Mises, said, every massive expansion, I'll paraphrase it, I don't know exactly how he said it, but every large expansion in credit is always followed by a contraction, or every boom is followed by a bust. It's just Mother Nature. And we expanded credit to the umpteenth degree and made money easy and rates low, which created distortions. And this expansion, this bubble in debt, has to be resolved at some point, either by continuing to blow it up or letting it all contract. And the contraction is the scary part, because that leads to, the greatest depression, not just the Great Depression, because of all of the leverage, and because everything would be coming from such sky-high prices, and because we have nothing in the way of savings and massive amounts of debt, and because of the systemic nature of all of the debt that has been lent out into a system. And this is why you're seeing, when we talk at the very beginning about the reluctance of banks to lend with one another, well, that's how it starts. There's just too much of this excess and this fear and the potential to damage your balance sheet if you're a bank. They'd rather just park the money with the Fed. And all of this money that's been created, that's been given to the banks, it's weird because at the same time, the Fed is just paying them enough monies to where they don't want to lend it out into this economy, so they give it to the Fed. It's a weird environment right now, Dunnigan, and that's part of the reason why you hear people say there's a shortage of dollars, because all that money that was printed is holed up in reserve accounts at the Fed right now. It's very strange, but we haven't seen the end of the problems. In fact, I think they're just beginning, and probably right after the election.